Well, Lisa, this is not going to be news. Good news. Down at 1600 Pennsylvania Avenue, the CPI comes in up 1% for the month of May. That is higher than the 0.3 we saw in April and much higher than the 0.7 that had been forecast. Core comes in up 0.6%. That is the same as it was the prior month, but it is higher than what had been anticipated. On a year-over-year basis, when you're looking at where inflation is, we thought we could say it peaked last month. It did not. It was up 8.3% in April, 8.6% for the month of May. That matches the all-time high in this cycle. And the core rate up 6%. That's a little bit lower than last month's 6.2%. And that's kind of what we've been expecting, given the fact that the energy complex is driving so much of what's going on. And let's take a quick look at that.
Hey everyone, it's been bad and it's getting real bad because of inflation. The month-over-month inflation is at 1% and the headline number is at 8.6%. That's been most in past 40 years. Analysts were predicted that the inflation will range from 0.4% to 0.7% for the month of May. They have been crazily wrong because it shot up to 1%. In spite of inflation inflecting down, it actually went up. Airfares, oil, food and other services, everything has shot up. Nasdaq on Friday immediately sank to 3.5%. This inflation is hurting common man and we are in for more trouble. Even the University of Michigan consumer sentiment has fallen to lowest at 50.2 in June, the lowest it has ever recorded. The last lowest reading was in 1980s at 51.7. Now on 15th and 16th June there is an FOMC meeting. The Fed might take a more hawkish stance because they have been behind the curve all this while. They have to jack up the interest rates and we might be in for a surprise or a rug pull.
To see next week is a hawkish hike. So a promise to follow that the Fed is going to do everything it needs to do without it being limited to a couple of more months of 50 basis point hikes, for example.
So now I'm not going to ask you to guess at what the Fed will do next week and going forward, but if you were advising the Fed, would you say it's a matter of when you raise rates or how much you raise them? That is to say, is this a matter of let's get there faster, but the ultimate number we're getting to is not that much higher? Or do these numbers suggest actually you're going to end up higher? So now,
I think you might need to get higher. That's the reality. Because, you know, I did see something which has baffled me about the Fed dot plots from March, and that's actually almost as interesting as the actual meeting next week, is that the Fed essentially had inflation coming down almost by itself. There was, in the sense that you had massively negative rates, even as inflation was collapsing in those dot plots. I don't think that's realistic, not in the least. Therefore, I will be looking for some added layer of sober realism in what the Fed shows us next week. And to your question, is it how much or is it when? I think it's actually both. It's probably going to need to be higher rates, and we need to get there faster. It's smarter to get there faster because, let's put it this way, we've had a full year of inflation being above 7%. We've had 2 years of inflation being actually above 6%. So when do expectations start catching up with this?
Fed might change stance to keep 50 to 75 basis points interest rate hike in September, or might do more in July and August itself. That will definitely shock the stock markets. Fed don't care about the market, but they definitely care about inflation, and that's their priority right now. Let's see how much the market will react this week, especially after the FOMC meeting. Crypto also being bashed badly. Since now crypto is a risky asset, it is also getting hammered. Bitcoin is now hovering around 27K, while Ethereum broke down $1,500 support. On the other hand, oil is just peaking to its recent highs. And honestly, I don't see any sign of relief in either of these. The US 10-year Treasuries have shot above 3%. Whenever the yield on Treasuries goes up, obviously the stocks comes down. There's a strong probability that S&P 500 may enter a bear territory. That means they could crash 20% from their recent highs. Some analysts believe that the only option with Fed is to force the recession on US economy to bring it out of inflation. The positive part is the core CPI came at 6% versus 6.2 from April, which is not a big difference. On the China front, they are easing COVID lockdowns, which could release pressure on the supply and demand cycle. While Tesla has announced that they will be doing a 3-to-1 split, which could move the stock a bit higher. My game plan, as I stated earlier, that this could be a bear market rally, and I believe that it is over now. If you're not a professional trader or just follows hype or think stock market will reach its highs soon because somebody said it, you're gonna chop yourself off. I'm only playing with bearish option strategy till I believe that the Fed has inflation under control or inflation itself starts to inflect down. You better stay out of the market if you cannot be patient, because earnings of companies not gonna do any better in the next 2 quarters. There will be definitely great opportunities in 9 months to 1 year, so you don't have to really rush into the stock market. I'll be continue playing the old games with my favorite stocks, which is Tesla, QQQ, Nvidia, and Phase, by playing some call and put options. I will also be adding some Ethereum to my crypto front, but I still believe it is risky and it's still very volatile. So if you want to be updated with the stock market and crypto, don't forget to like and subscribe to the channel. See you in the next one.